Welcome to the Alex Vogager, June 20, 2019. Comparing cryptocurrencies to traditional investments. Building capital appreciation. Boosting income potential. Empowering people with cryptocurrencies. Why invest in cryptocurrencies? Why invest in cryptocurrencies? Whether you're a seasoned investor who has been exposed only to investment assets other than cryptos, or you're just starting to invest in anything for the first time, you're probably wondering why you should consider including cryptocurrencies in your portfolio. You've probably heard about Bitcoin here and there. Heck, you may have even heard of other cryptocurrencies such as Ethereum and Litecoin. But what's the big deal about all of these funny-sounding coins anyway? Is Litecoin just a very light coin that won't take much space in your physical wallet? Is a Bitcoin made of bits and pieces of other valuable coins? Why on earth should you invest in bits of coins? You can read all about the different types of cryptocurrencies, what they're made of, and what their purpose is in Chapter 8. Here, I give you a general overview of the market as a whole. That way, you can decide whether the cryptocurrency industry is the right route for you to grow your wealth. Cryptocurrency investing may make sense for many investors, for a growing number of reasons, from things as simple as diversification to more exciting stuff like joining the revolutionary movement toward the future of how we perceive money. In this chapter, I show you some exciting features of this new investment kid on the block. Diversification is the good old don't put all your eggs in one basket thing. You can apply this advice to literally anything in life. If you're traveling, don't put all your underwear in your checked-in luggage. Put an emergency pair in your carry-on in case your luggage gets lost. If you're grocery shopping, don't buy only apples. Even though they say an apple a day keeps the doctor away, you still need the nutrition in other kinds of vegetables and fruit. You can go about investment diversification in so many ways. You can diversify with different financial assets, like stocks, bonds, foreign exchange, forex, and so on. You can diversify based on industry, like technology, healthcare, and entertainment. You can allocate your investment by having multiple investment time frames, both short-term and long-term. Adding cryptocurrencies to your investment portfolio is essentially one way of balancing that portfolio. Especially because the cryptocurrency industry is vastly different from traditional ones, this diversification may increase the potential of maximizing your portfolio's growth. One of the main reasons for this higher potential is that the cryptocurrency market may react differently to various global and financial events. Stocks. The stock market gives you the opportunity to take a bite of the profits a company makes. By buying stocks of that company, you become a part owner of that firm. The more stocks you buy, the bigger your slice of the cake. And of course, the higher the risk you face if the whole cake is thrown out in the garbage. The stock market is perhaps one of the most appealing investment assets. Novice investors may pick up a stock or two just because they like the company. For most investors, the charm of stock investing is the possibility that the prices will increase over time and generate significant capital gains. Some stocks even provide you with a periodic income stream through something called dividends. Regardless, for most stocks, the dividends paid within a year are nothing compared to the increase of the stock's value, especially when the economic environment is upbeat. This is precisely what stocks and cryptocurrencies have in common. When their respective markets are strong, you can generally expect to benefit from price appreciation. Make no mistake, though, both markets have their bad days and sometimes even bad years. The stock market has a longer history that can guide investors through navigating the future. For example, even though it may not always seem like it, bad days happen less often than good ones. However, stock investing naturally has some disadvantages. For example, stocks face different types of risks. Even the most awesome stocks have risks that you can't easily eliminate, such as the following. Business and financial risk. Purchasing power risk. Market risk. Event risk. Government control and regulations. Foreign competition. The general state of the economy. The stock selection process can be a pain in the neck. You have literally thousands of stocks to choose from. Predicting how the company will perform tomorrow can also be very difficult. After all, the price today only reflects the current state of the company or what the market participants perceive it to be. By investing in the cryptocurrency market, you may be able to balance out some of the preceding risks. The cryptocurrency selection process is also different from that of stocks. The final disadvantage of stock investing, however, is similar to that of crypto investing. They both generally produce less current income than some other investments. Several types of investments, such as bonds. Cryptocurrency investing is quite asymmetric. Rightly timed, crypto investing can produce an enormous return on investment, ROI. For example, NXT has a 697,295% ROI, Ethereum has a 160,100% ROI, and IOTA has a 282,300% ROI since their initial coin offerings. There is no other investment in the world that can top that. The best performing stock is Netflix, and that's around 64,000% in 10 years. Bonds. Bonds are also known as fixed income securities. They're different from cryptocurrencies and stocks in that you loan money to an entity for a period of time, and you receive a fixed amount of interest on a periodic basis. Hence its categorization as fixed income. Just like with cryptocurrencies and stocks, you can also expect capital gains from bonds. But these capital gains work a bit differently. Because the companies issuing bonds promise to repay a fixed amount when the bonds mature, bond prices don't typically rise in correlation with the firm's profits. The bond prices rise and fall as market interest rates change. Another similarity among bonds, cryptocurrencies, and stocks is that they're all issued by a wide range of companies. Additionally, many governmental bodies issue bonds. So if you're looking to diversify only within the bonds market, you still can choose from a range of relatively safe ones to highly speculative ones. Compared to cryptocurrencies and stocks, bonds are generally less risky and provide higher current income. But they still are subject to a variety of risks. Some of the risks involved with bonds investing are similar to those of cryptocurrencies and stocks, namely, purchasing power risk, business and financial risk, and liquidity risk. Bonds have an additional type of risk known as the call risk or prepayment risk. Call risk is the risk that a bond will be called, or retired, long before its maturity date. If the bond issuer calls its bonds, you'll have to find another place for your funds. The potential for very high returns on bonds is much lower compared to cryptocurrencies and stocks, respectively. But the risk involved with bonds is also comparatively lower. Forex. Here's an alternative investment that may be even riskier than cryptocurrencies. Forex is the geek term for the foreign exchange market. It's the first thing I ever invested in. By participating in the Forex market, you buy and sell currencies. Not cryptocurrencies, but fiat currencies such as the US dollar, the euro, the British pound, the Australian dollar, or any other currency any government issues. A fiat currency is a country's legal tender that's issued by the government. Before Bitcoin became the celebrity of financial assets in 2017, most people associated cryptocurrencies such as Bitcoin with the traditional Forex market because cryptocurrency includes the word currency, and crypto owners hope to use their assets to make payments. However, as I mentioned earlier in this chapter, cryptocurrencies also have a lot in common with stocks. When you participate in the Forex market, you don't necessarily invest for long-term capital gains. Even the most popular currencies such as the US dollar are subject to a ton of volatility throughout the year. A good US economy doesn't always translate into a stronger US dollar. Heck, sometimes some countries, such as Japan, prefer to have a weaker currency because they rely heavily on exports. If their currencies are stronger than the currency of the country they're trying to sell stuff to, they get a lower rate to sell the same product abroad than domestically. Participating in the Forex market as an investor mainly consists of short to medium-term trading activity between different currency pairs. You can buy the euro versus the US dollar, the euro to US dollar pair, for example. If the euro's value appreciates relative to the US dollars, you make money. However, if the US dollar's value goes higher than the euro's, you lose money. Analyzing the forex market needs a very different approach when compared to stock and cryptocurrency analysis. When looking at the forex markets, you need to focus on the issuing country's economic state, its upcoming economic figures such as its gross domestic product, GDP, or the value of the goods produced inside the country, unemployment rate, inflation, interest rate, and so on, as well as its political environment. However, just like the cryptocurrency market, you need to trade forex in pairs. Traders can make money by speculating which direction the couple will move next. You can apply a similar concept to the cryptocurrency market. For example, you can pair a Bitcoin, BTC, and Ethereum, ETH, against each other. You can even pair up a cryptocurrency such as Bitcoin against a fiat currency such as the US dollar and speculate their value against each other. However, in these cases you need to analyze each currency, crypto or fiat, separately. Then you need to measure their relative value against each other and predict which currency will win the couple's battle in the future. You can also consider cryptocurrencies as a cross between stocks and forex. Though many investors invest in cryptocurrencies for capital gain purposes, you can also trade different cryptocurrencies against each other, the way you can in the forex market. Precious metals. Time to compare one of the most recent man-made means to buy stuff, cryptocurrencies, to one of the most ancient ones. No, I'm not going back all the way to bartering, where people exchange their goods and services to fulfill their needs. In the following sections, I talk about the stuff with a bling. Before the advent of paper money, precious metals such as gold and silver were long used to make coins and to buy stuff. The precious metals comparison is actually the best argument when someone tells you cryptocurrencies are worthless because they don't have any intrinsic value. Getting a little background: back in the days of bartering, people would exchange stuff that provided real value to their human needs, chickens, clothes, or farming services. Supposedly, people in the ancient civilization of Lydia were among the first to use coins made of gold and silver in exchange for goods and services. Imagine the first shopper who tried to convince the seller to accept a gold coin instead of 3 chickens that could feed a family for a week. This change was followed by leather money, paper money, credit cards, and now cryptocurrencies. Some may argue that precious metals like gold do too have intrinsic value. They're durable. They conduct both heat and electricity and therefore have some industrial application. I know I used some gold and silver in experiments back in the day when I was studying electrical engineering in Japan. But to be honest, most people don't invest in precious metals because they're trying to conduct electricity. They primarily buy them to use as jewelry or currency. Today, market sentiment mainly determines the value of gold and silver. Silver has more use as an industrial metal than gold does. Silver is used in batteries, electrical appliances, medical products, and other industrial items. However, despite the additional demand, silver is valued lower than gold. For example, at the time of writing, silver is priced at $16 per ounce, while gold is traded above $1,250 per ounce. Keep in mind that England didn't establish gold as its standard of value until 1816. Standard of value means tying the value of the currency to its value in gold. In 1913, the United States finally jumped on board through its Federal Reserve System. It backed its notes by gold and aimed to ensure that notes and checks would be honored and could be redeemed for gold. Even though precious metals don't have an arguable intrinsic value, they have long been a favorite investment tool among market participants. One of the main reasons is their historical association with wealth. Often, when investments such as bonds, real estate, and the stock market go down or the political environment is uncertain, people flock to precious metals. People prefer to own precious metals at these times because they can actually physically touch metals and keep them in their homes right next to their beds. Comparing precious metals to cryptocurrencies. Besides the fact that you need to mine in order to get your hands on precious metals and some cryptocurrencies, one key similarity between precious metals and cryptocurrencies is that both categories have unregulated characteristics. Gold has been an unregulated currency at various times and in various places. Unregulated currencies become more valuable when investors don't trust the official currency, and cryptocurrencies just seem to be another example of this trend. Investing in precious metals comes with a number of risk factors you need to keep in mind. For example, if you're buying physical precious metals as an investment, you must consider their portability risk. Transferring precious metals can be expensive given their weight, high import taxes, and the need for a high level of security. In contrast, you don't need to make a physical transfer with cryptocurrencies, besides the hardware crypto wallets, but moving cryptocurrencies is much faster and less expensive, even with a hardware wallet, than transferring precious metals. On the other hand, cryptocurrency prices have been more volatile in the short time they've been available on the markets than all precious metals combined have. The 2017 volatility in particular was due to the hype in the market, as I explain in Chapter 3. As cryptocurrency investing becomes more mainstream and more people use it for everyday transaction, crypto prices may become more predictable. Capital appreciation refers to the increase in the price or value of cryptocurrencies. And it's one of the reasons many investors, and non-investors, for that matter, look to jump on the cryptocurrency train. Initial Bitcoin owners sure waited years before they saw any sort of capital appreciation. Personally, I was one of the skeptics of the whole thing. Back in 2012, one of my investor friends in Switzerland told me to buy some Bitcoin. I arrogantly ignored him, and boy, did I regret my arrogance later. I started investing in cryptocurrencies when the price of Bitcoin had surged significantly. However, with some research, I was able to find more affordable cryptocurrencies that were expected to have similar capital appreciation. Most of the gains in the cryptocurrency market up to 2017 were a result of market hype. In 2013, for example, many people bought Bitcoin as its price approached $1,000 for the first time. As you can see in Figure 2.3, shortly after, its price crashed to around $300, where it stayed for the following 2 years. The next big wave of growth came in January 2017, when Bitcoin's price broke above the $1,000 level. If you had bought one Bitcoin at $300 at the end of 2015, by January 2017 you would have had $700 worth of capital appreciation. For people who had bought, or mined, Bitcoin when it was valued at around $300 and held onto it throughout the volatility, the crash to $6,000 wasn't that big of a deal. For every Bitcoin they'd bought at $300, they had around $5,700 worth of capital appreciation even if they didn't cash their Bitcoins in when the value reached above $19,000. People who bought Bitcoin at around $1,000 and cashed it out at $19,000 at its 2017 peak would have made $18,000 for every Bitcoin they owned. Of course, those who bought Bitcoin at $19,000 had to sit on their hands and eat their losses after the crash. Many market participants compare Bitcoin and other cryptocurrencies' appreciation to the dot-com bubble from the mid-1990s and early 2000s. According to Fortune magazine, since its creation in 2009 until March 2018, Bitcoin saw 4 bear, falling, waves, where prices dropped 45 to 50%, typically rebounding an average of 47% afterward. During the dot-com bubble, the Nasdaq Composite Index had 5 of those waves, averaging 44% declines followed by 40% rebounds. Trading volume patterns are also eerily similar. Nasdaq has clearly rallied nicely from its low in 2002. Though history and past performance aren't indicative of future behavior, crypto enthusiasts have reasons to believe that growth potential for cryptocurrencies may be similar to the Nasdaq rebound, if not better. Huge growth potential. Bitcoin and cryptocurrencies were the biggest investment story of 2017. Stories appeared daily on CNBC, and in the Wall Street Journal and New York Times, about people becoming millionaires practically overnight. However, after January 2018, the price of Bitcoin fell 63%. The media followed suit appropriately, saying the opportunity had passed, that the cryptocurrency bull market was over and the bubble had burst. This tune was interesting, especially because many billionaires became crypto investors at this point. For example, JP Morgan CEO Jamie Dimon, who had called Bitcoin a fraud and said any JP Morgan traders caught trading Bitcoin would be fired, became one of the most active buyers of a fund that tracks the price of Bitcoin. The price of Bitcoin fell as much as 24% in the few days that followed Dimon's statement, and sure enough, right in that period, JP Morgan and Morgan Stanley started buying for their clients at low prices. This story isn't alone in the crypto market. For example, after slamming Bitcoin at the World Economic Forum in Davos, Switzerland, in January 2018, calling it a bubble, hedge fund titan George Soros gave the green light to his $26 billion family office to begin buying cryptocurrencies just 8 weeks later. Interestingly, Soros attributes part of his success to his understanding of what he calls reflexivity. In simple terms, this theory states that investors base their decisions not on reality but on their perception of reality. Soros once said, "The degree of distortion may vary from time to time. Sometimes it's quite insignificant, at other times it is quite pronounced. Every bubble has two components, an underlying trend that prevails in reality and a misconception relating to that trend. The problem is that most people have no clue what's really going on in the cryptocurrency market. And most have no idea where the price is about to go next. The majority of those interested in the market are taking their cues from market noise, making it way easier for the prices to fall when the big movers downplay for their own benefit. When the majority of the market panics about the drops in the value of an asset, it is often the best time to stack up on it. You can say the same about the cryptocurrency market. For the cryptocurrencies with strong blockchain technology behind them, once the price bottoms out, there is nowhere for its value to go but up. Although gaining capital appreciation is one of the most attractive features of cryptocurrency investing. A bit about traditional dividends. By definition, a dividend is a sum of money public companies pay their shareholders on a regular basis. U.S. corporations pay billions of dollars worth of dividends every year. Yet in spite of these numbers, many investors, especially young ones, don't pay much attention to dividends. They prefer capital gains because the rewards can be quicker and can way exceed any amount of dividend payment. In the traditional stock market, companies typically pay dividends on a quarterly basis. A firm's board of directors decides how much to pay shareholders in dividends or whether to pay dividends at all. Sometimes, the directors decide to pay dividends because the stock value isn't doing so well. So they select a higher dividend rate to keep investors interested in buying the stocks. Investors with lower risk tolerance may prefer dividend payments to capital gains because dividend payments don't fluctuate as much as the value of stocks do. Furthermore, if the markets crash like they did in 2008, dividends can provide nice protection. The best way to accumulate dividends is to hold onto your assets long term. The basics on crypto dividends. During the crypto mania of 2017, many cryptocurrency platforms were quick to realize the importance of regular payments to keep investors happy. But these payments can be a bit different than traditional stock dividends. You can generate regular, passive income in the crypto market in several ways. Here are the two most popular ones. Hodling. No, this term is not a typo for holding, although it has a similar meaning. It stands for hold on for dear life. It is the closest payment to traditional dividends. Some cryptocurrencies pay out the hodlers, who simply purchase and carry the digital coins in their wallets. Proof of stake, POS. This is a lighter version of proof of work in cryptocurrency mining, which I explain in Chapter 7. When you stake a coin, it means you put it aside so it can't be used in the blockchain network. If you have a ton of stakes, you have a higher chance of getting paid at a random selection by the network. Annual returns for staking vary between 1% and 5%, depending on the coin. Some of the most popular dividend-paying cryptos in 2018 are NEO, ARK, and exchange cryptocurrencies like Binance and KuCoin. While receiving cash, or digital coins, just for holding onto your assets is pretty cool, sometimes it makes more sense to cash out and reinvest your holdings to get a better return. Fueling ideological empowerment. Just as oil is the lubricant that allows a machine to operate, blockchain technology is the lubricant that enables the cryptocurrency market. Blockchain is the underlying technology for cryptocurrencies, not to mention one of those breakthrough developments that has the potential to revolutionize nearly every industry in the world completely. Blockchain can offer so much more as it's aiming to resolve many economic and financial problems in the world today, from dealing with the flaws of the sharing economy to banking the unbanked and underbanked. Here are some of the kinds of social good that come through cryptocurrencies and the blockchain technology. The economy of the future. We live in an era where the sharing economy is exploding. The sharing economy allows people to rent out their own property for use by others. Internet giants such as Google, Facebook, and Twitter rely on the contributions of users as a means to generate value within their own platforms. If you've ever taken an Uber or a Lyft rather than a taxi or rented a room on Airbnb instead of a hotel, you're a part of the sharing economy crowd. However, the traditional sharing economy has its issues, such as the following: requiring high fees for using the platforms, hurting individual users but benefiting the underlying corporation. In most cases, the value produced by the crowd isn't equally redistributed among all who have contributed to the value production. All the profits are captured by the large intermediaries who operate the platforms. Playing fast and loose with consumer info, some companies have abused their power by getting access to private data without customers knowing. As the sharing economy expands in the future, its problems will likely become more complicated. In order to combat these issues, several companies are developing blockchain-based sharing economy platforms. These platforms are much more affordable to use and provide much-needed transparency. They limit, and sometimes completely cut out, the need for a centralized middleman. This shift allows true peer-to-peer interactions, eliminating the 20 to 30% transaction fees that come with centralized platforms. Because all transactions are logged on blockchains, all users can audit the network's operations. This approach is possible because of the decentralized nature of blockchain technology, which is ultimately a means for individuals to coordinate common activities, to interact directly with one another, and to govern themselves in a more trustworthy and decentralized manner. Some cryptocurrency transactions aren't entirely free. In many cases, every time there is a transaction on a blockchain, you have to pay the network fees, which are funds payable to the blockchain network members who are mining your coins/transactions. If you take into consideration the time wasted waiting for a transaction to clear, for example, it takes 78 minutes for a Bitcoin transaction to reach consensus, then in reality you may not save anything in fees by going to some blockchain applications. Blockchain remains the fuel behind the economy of the future, and cryptocurrencies are a byproduct to pave the way by distributing the global economy. Freedom from government control of currency. The rise of Bitcoin and other cryptocurrencies as a trillion-dollar asset class in 2017 was spurred without the oversight of a central bank or monetary authority guaranteeing trust or market conduct. Unlike fiat currencies such as the US dollar and the euro, most cryptocurrencies will never be subject to money printing, officially called quantitative easing, by central banks. Most cryptocurrencies operate under controlled supply, which means no printing of money. In fact, networks limit the supply of tokens even in cases where the demand is high. For example, Bitcoin's supply will decrease in time and will reach its final number somewhere around the year 2140. All cryptocurrencies control the supply of the tokens by a schedule written in the code. Translation: the money supply of a cryptocurrency in every given moment in the future can roughly be calculated today. The lack of government control over cryptocurrencies can also help with lower inflation risk. History has shown over and over again that when a particular government applies bad policies, becomes corrupt, or is faced by crisis, the country's individual currency suffers. This fluctuation in the currency value can lead to the printing of more money. Inflation is the reason why your parents paid less than $1 for a gallon of milk while you have to pay at least $3. How awesome would it be if cryptocurrencies can get rid of government-controlled inflation so that your grandchildren don't have to pay more for stuff than you do? Help for the unbanked and underbanked. One of the most noble problems cryptocurrencies can solve is banking the unbanked. According to Cointelegraph, 2 billion people in the world still don't have a bank account. Most of them live in low and middle-income emerging markets, but even in high-income countries, large numbers of people are unable to use banks to meet their day-to-day financial needs. This means they don't have access to the convenience, security, and interest that banks provide. Moreover, many people are underbanked. They have access to a bank account but don't have adequate access to the financial services that banks can provide. Even in the United States, for example, 33.5 million households in 2015 were unbanked or underbanked. Without access to savings and credit, these people can't participate in the cycle of economic growth. Cryptocurrencies, with the help of blockchain technology, have the potential to help the unbanked and underbanked by letting them create their own financial alternatives efficiently and transparently. All someone needs to start using cryptocurrencies such as Bitcoin and send and receive money is a smartphone or laptop and internet connection. Thanks for watching this video. Help us with a like to upload more content to this channel and subscribe. Comment and comment. Thank you forever.